Good morning, hedge fund investors. For our investment thesis, we'd like to consider the event of war between China and Taiwan and the impacts that would likely stem from this event. In the event of this war, we'll propose a buy recommendation for Taiwan Semiconductors Limited and a sell recommendation for China Airways Limited. China's ultimate desire to remain entirely independent from Taiwan has long been prescribed under the One China policy, demanding that any country that seeks to engage with China in diplomatic relations must officially break ties with Taiwan. Further, the recent visit to Taiwan by US politician Nancy Pelosi has only strengthened the bond between these two countries. However, these relations have left China reeling, with further statements stemming from Beijing asserting confidence in their ability to retake Taiwan by force if necessary. Already, China's 5-year plan for national economic and social development has suggested towards increasingly hostile policy, of which will only be exacerbated by the war. This report states a strong commitment to technological self-reliance with the goal of developing an increasingly dominant market compared to international circulation. The Chinese government has hinted towards this by aiming to grow research and development funding to 7% of total GDP. This will be financed through higher taxes, putting the Chinese economy into an inflationary state, thereby raising interest rates. Coupled with aggressive restrictions on the import and export of assets, services, and civilians, industries related to transport, tourism, and travel will be devastated. Such impacts have already been seen in the Russia-Ukraine war as displayed below. In relation to Taiwan, potential invasion by China will see a short-term decrease in production due to restricted access to materials and labor. As a result, it is likely Taiwan will implement expansionary monetary policy through increased expenditure on infrastructure and technology, thereby boosting demand and consumption. Taiwan's position as a leading technological powerhouse, coupled with strong commercial ties with the United States, provides strong opportunity for long-term economic recovery. This has recently been observed in Ukraine, where production of various grains has reached a long-term high even in the context of war. This being said, I'd like to invite Hannah to present her investment recommendation.
Thanks, Colin. Let's start with our potential candidate, which is TSMC. TSMC is the world-leading semiconductor foundry, accounting for 54% of global foundry revenue in 2020, with gigantic technology clients such as Apple's, Qualcomm, and NVIDIA. TSMC's structural growth is driven by strong market demand for 5G and high-performance computing applications, thanks to its leading-edge and specialty technologies. As described in two graphs on the right-hand side, TSMC customers are mainly from the US, while platform with high sales value is smartphones and high-performance computing. TSMC currently has a large network of operation with 5 manufacturing facilities, 2 in US, 1 in Taiwan, 1 in Japan, and 1 mainland China. Besides, TSMC is in the process of upgrading 2 factories in Japan and US, with production target for new technologies to be in 2024. So along with the current operation and future plans that we observe for TSMC, below catalysts have been incorporated into our model as well. Firstly, what is the key impact that our thesis have onto valuation? This is predicted to be more like a short-term event. Year-on-year revenue growth is expected to decline significantly in FY22 and 23 due to major production delays in Taiwan. Thinking about the importance of TSMC and linking back to Colin's point about grain price, we do hold the same assumption that supply shortage would rise semiconductor price to sky high. Furthermore, we strongly argue that TSMC operation will not be invaded directly, as China is relying heavily on TSMC. Secondly, as a beneficiary of $75 billion US federal funding package, rising secular demand and stronger balance sheet position would continue to help TSMC materialize its growth potential. Our DCF model arrives at a share price of 508.22 new Taiwan dollars and gives 16.03 upside to current share price by using a WACC of 8.76% and terminal growth rate of 2.41%. After arriving at our price target, we cross-check with median EBITDA EV and EBIT EV, and this arrives share price of $584.43. Seed company chosen operating in the same segment, comparable in terms of market cap, geographical risks, and growth potential. With that, I will now pass on to Jason to discuss about our sale recommendation.
Thank you, Hannah. For our short option, we are presenting to sell the Taiwanese flag carrier airline, China Airlines. This company is in a precarious situation as should war break out in the country, 90% of the company's revenue is reliant on flight cargo in and out of the country. As shown in other case studies, it is typical to see major flight restrictions during times of war, whether it be sanctioned by external countries or for the safety and protection from within. The effects of a short-term event such as a political war will have devastating effects on long-term valuation of the firm as it struggles to recover to its current position, as seen in a discounted cash flow model. This is compounded by the likelihood of the firm downsizing to survive and whether international firms wish to come back to trade. Currently, China Airlines price-to-book ratio is presented significantly higher than similar firms in the market, as it's currently pricing in a high-growth respective scenario due to the recovery from the COVID-19 pandemic. Ryanair Holdings is at an indicative future scenario, significantly higher EV/EBITDA ratio of 197.31. This demonstrates a very severe earnings drop in the firm with only partial income loss from a war event. The income loss from a firm inside a war zone would be expected to be significantly more severe. The combination of the two can create a large short position for investors while proving drastically smaller potential long-term valuations of the firm. On behalf of my team, I'd like to thank you all for listening.